Hi guys and welcome back to the Mindful Investing channel. Today Buffett's Berkshire Hathaway revealed a 10% stake in HP. So let's have a look at HP stock today and try to come up with expected annual rates of return if we were to invest into HP stock right now. As always, we'll value HP using our simple discounted cash flow model. To be able to value HP using this simple DCF, we have to first make a couple of assumptions. First, we have to assume HP's free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. Then we have to assume HP's price to free cash flow multiple at the end of our holding period, so basically in 10 years. Finally, we have to assume HP's annual buyback yield over our holding period. So let's begin with our free cash flow growth rate assumptions. Personally, I like to base my future free cash flow growth rate assumptions on HP's historical free cash flow growth rates. When we look at HP's historical free cash flow, we see that it's basically been all over the place over the last couple of years. Because there's been a huge spike in HP's annual free cash flow in 2021, probably because of the COVID pandemic, I only assumed a future free cash flow growth rate for the next 5 years of -3% and for the 5 years following those 5 years of -1% per year. Next, we have to assume HP's price to free cash flow multiple at the end of our holding period, so basically in 10 years. Because the multiple usually reflects the future growth potential of a company, and I assumed negative growth rates for the future, I only assumed a price to free cash flow multiple of 8 at the end of our holding period. Next, we have to assume HP's future annual buyback yield. Like with our growth rate assumptions, I like to base my buyback yield assumptions on HP's historical buyback yield. When we calculate HP's annual buyback yield based on the last 5 years, we come up with a buyback yield of roughly 6.9% per year. To be conservative, I only assumed a future buyback yield of 4.5%. Because we calculated the free cash flows to the whole company, which is usually financed by debt and equity, which bear different costs, we have to reflect those different costs in our discount rate. To do so, in our simplified DCF, we just enter HP's market cap, its interest-bearing debt, and its interest expenses. So now we can finally calculate our expected annual rate of return, so basically our IRR over our holding period, by simply adjusting our cost of equity until the number in the green box is equal to HP's enterprise value per share. When doing so, we come up with an annual rate of return of 16.3%. So even based on our conservative assumptions, HP seems like an interesting investment. So that's it for today's video. Please always remember to do your own due diligence, your own research, and to never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.